Greetings, everyone. I'm David Darst, here to give you a recap of the month of July 2024. It was a month that was loaded with news and important developments affecting financial markets and asset prices. Starting with the June jobs report, which came out in early July, you had 206,000 jobs created. At the same time, the May numbers were revised downward from 273,000 to 193,000. So you had somewhat offsetting developments in the jobs market. At the same time, unemployment went to 4.1%. And as you may recall, it's risen from 3.4% back in January of 2023 and April of 2023. So very quietly, silently, unemployment has been rising over the past 12 to 18 months. We'll see where it goes as we get this first reading in just a couple of days at the beginning of August for July's jobs numbers, and importantly, not only the unemployment rate, but the average hourly earnings. It's come down quite a bit. The Fed is aiming for a target of about 3.5% year over year. The latest was 3.9%. Which was given in the early part of this month, early July. The ISM manufacturing and the ISM services, both of them were below 50, which means they're in contractionary mode. We'll be watching those very carefully to see if services bounces back up into expansionary mode. As you may recall, we had four big assumptions that were powering asset prices as this year has progressed. As you know, number one, the Fed cutting interest rates. Looks like almost 100% chance of a Fed cut in mid-September at their September Federal Open Market Committee meeting. Also even a chance of perhaps a 50 basis point cut. So 25 is pretty much in the bag, maybe even 50%. Right now that's only a 14% chance with perhaps an 80% chance of a 25 basis points cut. So we'll be watching that one very carefully. The core consumer price index mid-month in July 11th, the core consumer price index came in at 3.3% for June versus 3.4% for May. That's not a big move, but it shows this continued downward move in inflation. So number one, Fed cuts. Yes, that's continuing, not as many as expected before, but it is continuing. Inflation moderating, yes. At a slow pace, yes. The economic resilience, that part of it seems to be also intact, but we do notice a slowing around the edges there. Retail sales, for example. Let me just give you the progression, January through June. January minus 1.1% month over month. February plus 0.9%. March plus 0.6%. April down 0.3%. May up 0.3%. And June flat. So you see a slow moderation in retail sales, and that's basically a good proxy for consumption, which has been maintained, but we're watching that carefully because it does show a pace of slowing. And then the fourth pillar, Fed rate cuts, inflation, economy. The last one was artificial intelligence enthusiasm. And this really stands out in the month of July, which we've just finished. There was a big shift, a noticeable shift, where you had many of the big artificial intelligence-driven stocks and sectors, okay, the Magnificent Seven of the big big cap, high-tech companies. And what happened was you've seen people begin to question, they're spending a lot on this, but what's the return going to be? I've seen some reports. We have seen some reports showing that you would need about $600 billion in revenues to produce the profits that would be adequate given the amount of capital expenditures that have been laid out or are projected to be laid out in the artificial intelligence area, And these reports say it's not going to be 600 billion. It's going to be more like 100 billion of extra revenues. So we'll be watching this one very carefully. But that was one of the big stories of this month, where you had this shift from great enthusiasm, almost overdone enthusiasm of artificial intelligence sector, some questioning, and therefore NASDAQ came under pressure, and you had this big rotation and shift into the Russell 2000. More on that in a brief moment. The personal consumption expenditures core number came in at 2.6% year over year for June and 2.6% for May. So basically flatlining right now, which the Fed looks at very carefully. Earnings season began late in the month, the last week of July. You had Tesla, you had Google. Both of them somewhat disappointed, and that added to downward pressure on many of the high-tech stocks. You had Meta, you had Microsoft, you had Amazon, you had Apple late in the week and late in the month, at the very end of the month. So artificial intelligence fever cooled somewhat. Standard & Poor's was basically flat for the month. It was all over the place. It was flat for the month. NASDAQ, it was down 3.3% as of very late in the month. And Russell 2000, on the other hand, was up 9.5%. So you see this shift, this rotation that we've talked about. Gold was up 3.3%. Oil, disturbing and distressing geopolitical elements late in the month, as you know. Oil was, before that, had been down 8.4%. And as the month drew to a close, you did have a bid for oil, oil bouncing up somewhat. But before that, it had been down 8.4%. Two-year Treasury started this year, as you know, at 4.23%. It started this month of July at 4.71%. And as the month drew to a close, it was 4.35. So it was down about 36 basis points in the month. Again, that reflects expectations and thoughts about the Fed's likely move of monetary policy. And that's consistent with what we have been saying and what we've been expecting. Now, the 10-year Treasury, as you know, started this year at 3.88%. It started the month of July at 4.36%, and as the month drew to a close, it was in the neighborhood of 4.15%. So it was down 21 basis points during the month, and that's reflective, as you know, of the inflation outlook and the economic outlook, whereas the two-year is reflecting much more expectations about Fed monetary policy. Let me also address the inverted yield curve. The inverted yield curve, in the past, when it's been sharply inverted for a long time, and it's been inverted for 2 years now, 2 years, it started to invert in July of 2022. Here we are in July of 2024, and it's been inverted all that time. But when it begins to flip back to positive slope, which is its normal slope, after a very long time, that has not always been the most positive outlook for equities. The slope, it was, as you know, sharply, deeply negative for a good part of that 2-year time of the inversion. It's now it's basically starting to head towards positive slope, and the negative inversion is now only 20 basis points versus 35 basis points negative at the beginning of this year, and also 35 basis points negative at the beginning of this month. Looking ahead, August 19th through 22nd will be the Democratic Convention in Chicago. Many people will be looking at that. August 22nd to 24th will be the Central Bankers Symposium in Jackson Hole, Wyoming. And you usually get some sort of a policy direction or policy thoughts by Chair Powell at this, and we will be anticipating that. Then the Federal Open Market Committee meeting is September 17th, 18th. And there we do expect a cut of at least 25 basis points. September 20th through November 5th is the early voting period for the presidential election, which does take place on November the 5th. Let me just say that we think that the next 10 to 15% move will not be driven by politics, but rather it will be most likely driven by growth whether growth is going to be sustained or whether it is continuing to soften and to weaken. So that we think will be. Now, all of this boils down to the need and the exigency and the importance of including alternative investments in a portfolio today, a modern asset allocation, where you want to have not your traditional 60-40 stocks versus fixed income securities, but you really want to take part of each of those two asset allocated sectors, those categories, and devote that. And we've basically been focusing on credit, yes, some liquid credit, but also private credit, where you can pick up yield and reduce portfolio volatility with a decent credit standing if you're selective. That's private credit. Private real estate, very, very extra selective there, perhaps nice and high in the capital structure. And then finally, private equity, where you've seen a growing interest. And this one, I think we've been early on, and it's been a good place to be focusing on the secondary market interests, secondary partnership interests of private equity funds, where investors need liquidity, and so they're willing to sell them. 2 years ago, they were selling them at maybe about a 19 to 20% discount from their carrying value, then more like 13% discount, and now it's below 10% in the high single digits discount to their carrying value. So we think there's great opportunity there in the secondary partnership interests in the private equity sector. With that, we wish everyone a great start to the month of August, and we look forward to catching up with you very soon.